How many married couples have one party outlive the other? Almost all of them.
Welcome to Couple Bull. My name is Michael Dunham, and with me today is Patrick Fontana, the founder of Fontana Financial Planning.
Cheers, Michael.
Welcome, Patrick. So, Patrick, the topic of today's video is what are the tax planning considerations that I should think about after the passing of a spouse? And so to kind of set the stage for this conversation, I wanted to start by asking you, just tax-wise, after a spouse passes away, what happens tax-wise to somebody's situation?
Well, there's a few big things to consider. The first is, how does income change? Most of the time, income changes. If they're both drawing Social Security, instead of them each getting a check, there becomes one check. If there's a pension, is the pension lower for the surviving spouse? Does it stay the same, or does it go away altogether? Tax situation, what rate are they in? Married filing jointly has an advantage over single. So lots of things we can talk about.
Yeah, so let's dig a little bit deeper on a couple of those. So first, for Social Security, so the way that it works is if both you and your spouse have claimed your Social Security benefit, when the first spouse passes away, the higher benefit generally is the one that sticks around, and the lower benefit goes away. So if one spouse is getting $40,000 a year, one spouse is getting $30,000 a year. So as a couple, you've been getting $70,000 a year. The 30 is going to go away. The 40 is the benefit that's going to remain, but overall income is going to drop a little bit by the 30,000 that has gone away.
A little bit. 30,000, big number. So everybody's Social Security is different, and we've got a lot of Social Security planning we do with our clients, but it's important to know, what do you do and how do you get the most out of the system, and what happens at the death of the first spouse? What happens to the income for Social Security?
Yep. And then, so when we look at tax rates, which we'll pull up on the screen here, the tax bracket pyramid. And so on the right-hand side of this chart, you'll see the tax rates for a married couple filing jointly. And on the left-hand side, you'll see the tax rates for a single filer. And so the year that your spouse passes away is the last year that you get to file on the right side of this chart, the married filing jointly side of this chart. Generally, after the year of passing, you then have to file on the single side of the tax bracket pyramid. And so you'll notice that for most of these thresholds, it's roughly half the top of each tax bracket. And so depending on income situation, if you have a Social Security benefit that stays, a pension benefit that stays, maybe required minimum distributions, which oftentimes stay the same, or if they go down, it's very little. You can find yourself in a much higher tax bracket when you're filing single as opposed to married. And so a good example that I'll give is at $250,000 of gross income. On the married side, you're in the 24% bracket. On the single side, you're in the 35% bracket. So it's an 11% jump in that specific situation.
11%'s pretty big number when you're talking about extra money to the IRS. One thing that generally doesn't go down is required minimum distributions. So if you've got a husband and wife that each has a retirement account, let's say $1 million each, and they're both required to take out their required distribution each year, first spouse passes, that IRA now passes to their spouse, and their $1 million IRA goes to $2 million. The required distribution will at least stay the same. And if they're older than their spouse, the overall required number will go up.
So, Patrick, given that context, what are a couple of planning considerations that somebody who may find themselves in this situation may want to consider before year end, and then also after year end, to help mitigate and manage their tax bill as best possible?
So you'll know from experience that, like, the last 5 years, we've had this happen where the husband in these cases has passed away first. The wife we went in and reviewed things and decided during that year, while she's still married, filing jointly, to do a Roth conversion. Take some IRA money and convert it to Roth at the favorable married filing jointly tax rates. And what that did was set up the surviving spouse for a lower required distribution going forward and an overall less tax bill.
The other planning opportunity that I'll bring up, and this is both for the year of, but also a longer term tax planning consideration that really is available for anybody over the age of 70 and a half, but maybe more valuable if you find yourself as a single filer, is the ability to make what are called qualified charitable distributions. So for most retirees who are eligible, giving from your IRA directly to charity is often the best way to give. And so if you are a charitably inclined individual and you have these large required distributions that may be bumping you up into higher tax brackets on the single side, it'd be something to consider, is giving from your IRA as opposed to writing a check or giving to charity in any other form or fashion.
So one other thing that's important, and we've seen this mistake happen before, where in community property states, and I'll just name two, you could look up based on where you live, but California and Texas both qualify for this. There's a step up in basis. So for an investment account where we started with $500,000 and now it's worth $1.7 million, all of that gain, that built up gain, if you sell the investments, you pay long-term gains taxes or whatever, however long you've held the stocks. Most cases for us, it's long-term. One advantage of the death is the step up in basis. So the surviving spouse gets the $1.7 million and the cost basis is now $1.7 million. So there's no taxes on that gain. But what's important is that you raise that cost basis and handle it correctly.
And that applies not only to investments, it also applies to your primary residence if you have a vacation home in a community property state. So there's other assets that also qualify for this step up in basis. And the other thing that I'll add is if you're not in a community property state, which many states are not community property, that doesn't mean you don't get a step up in basis. It means you get a 50% step up in basis. So if you sold something in this scenario where we didn't get the full step up in basis, we'll have a lower tax bill. It just won't be eliminated. So making sure that you get the step up in basis is a very important thing to do, and it can be missed. But knowing based off of your state of residency and whether they're a community property state or not, you may get a full step up or you may get a partial step up in your cost basis.
So what should we do? You should consult with your qualified tax preparer, your financial planners, and you should subscribe to our content to get more information. Reach out to us, and we're happy to give guidance on both those topics.
Yeah. And if you are interested in a conversation, we do have a link down below in our show notes where you can set up a complimentary introductory call with a member of our team. That all said, Patrick, how do you want to wrap up today's show?
This might be a little gory, but I think maybe rebalance until death.
Rebalance with discipline.